Bloomberg Audio Studios. Podcasts, radio, news.
Let's get a little bit more detail. This is the ECAN function on the Bloomberg terminal. It really helps to break down the different inputs to overall CPI. The yellow bar is core services, the purple is core goods, then the red is energy, and then the blue is food. And what I find really interesting about this is the disinflationary trend that we saw back in 2024 is basically over in this last read. Maybe a little touch of a disinflationary trend when it comes to the core goods. But for the most part, everything else, energy and food, as well as services, is still rising. Now, albeit services inflation has come off the boil from what we saw back in 2024 in July, but still we're right around 40-year highs. And any way you look at it, those prices appear sticky. Plus, Romaine, if the disinflation narrative is over, then what?
Then what? Let's pose that question to our first guest. Kicking us off to the close is Esther George, of course, former Kansas City Fed president. And Esther, you've had a lifetime really of doing this. You've seen these various inflationary cycles, these various economic cycles. Should we be worried about a potential resurgence in inflation, or is this just that normal sort of bumpy road down to what I guess most of us hope is going to be that 2% target?
Yeah, well, thank you for having me today. And I think you have to be worried about this inflation, not because what we've seen so far tells us that there'll be a resurgence, but because this level of inflation has remained well above the Fed's target. And that, of course, is a principal job of the FOMC, is to make sure that inflation rate gets back to its 2% target in a timely way. And we've gone on some time now with inflation hanging out there a ways above that.
How dangerous is it, though? I mean, we still talk, at least if you take Powell's preferred measure, the core PCE, I mean, we're basically at around 3% on some of the headline CPI numbers. We're certainly in an area that I think a lot of people can live with, whether it's the economy, whether it's corporations, or whether it's the market. If the economy is healthy, as evidenced by consumer spending, as evidenced by the labor market, should we still be quibbling over 3.3% on core CPI?
Well, I think you do want to quibble over it because once an inflation psychology gets embedded in an economy, you begin to see inflation expectations change. And it's one of the things that would have my attention right now is the Fed has been able to rely on well-anchored inflation expectations over the course of this post-pandemic period. But if you look at recent prints, you will see that those are beginning to drift up. And even consumer expectations are beginning to signal expectations of future inflation. And that's why, in addition to the Fed's own credibility, you want to anchor that inflation at the Fed's stated 2% target.
A lot is being made, though, Esther, on seasonality, and there's January seasonality, sort of post-vacation movement there. You also had the LA wildfires, et cetera. Do you buy the seasonality argument?
Well, there's always an element there that you have to take note of. But I think what's particularly important right now is this isn't just a one-off data print. You have now seen a succession of reports that are telling us that inflation is hanging in there in the 3% range. And even though that's not the Fed's preferred indicator when they are making decisions, the truth is CPI tells us something because so many contracts in our economy are based off of this. And so it's not to be ignored, I think, and just dismissed at this point. And I'd be paying very careful attention to the numbers we've seen come in.
Now, clearly at the Fed, you guys look at PCE versus CPI. So is there a level for PCE that you guys used to talk about, okay, that's a hurdle for, say, talking about hikes?
Well, I don't think there was a particular level to talk about hikes because what you're always trying to figure out is that core level telling us something. Is it the headline, which can be volatile, as people know, with food and energy costs? I think what we've seen over the past few years, though, is something quite different. This is really telling us that there is real inflation in the economy. And the Fed has been quite clear, as I think they have to be, that they will not be satisfied that they have achieved their mandate until they get back to 2% on a sustainable basis. And so there's more work to do here, clearly.
Are you generally, though, satisfied with the communication that we're getting out of the Fed, whether it's coming directly from Powell or from some of the other FOMC members? Is that helping?
Well, the markets, I think, have already begun to take note that this idea of a steady pace of rate cuts is not likely to happen. And of course, with 100 basis points of cuts last year, the most recent one in December, those expectations are beginning to shift. And I hear that in the communications from the Fed, which is to say, we are not going to be moving. We have time. We want to watch and see what happens with the data. And this is true not only for inflation, but you see a number of other policy implications coming down the road as the new administration begins to look at various levers they have for the economy.
But does the Fed have that luxury of just waiting and seeing? And they've been waiting and seeing for a while now. And we played some comments earlier from Mohamed El-Arian, and he gave an interview on Bloomberg Television where he talked about, in his words, what he sees as a lack of strategic vision on the part of the Fed. This idea of just wait for the whites of the eyes before you shoot. And he seems, and certain folks in the market also seem to think that maybe the Fed should be a bit more proactive.
So I think the Fed is certainly going to have to be talking about this. And if you listen to their language, they continue to refer to current interest rates, even at that 4.25%, 4.5%, to be in restrictive territory. Some refer to it as meaningfully restrictive. Some have said maybe it's getting close to neutral. And so I suspect at their upcoming meeting, this has to be a real point of discussion, is really narrowing in on where they think they are and how they will communicate what their stance is going to be relative to the objective that's in front of them.
Esther, isn't it all confusing as to why it seems like the feed through from rates from monetary policy to the real economy has been somewhat stymied?
Yeah, I think that's been interesting to see whether the transmission of policy has changed. And you can look at some of the reasons why that might be. For example, just look at a market that tends to get hit directly in real estate, and particularly residential real estate. When most of the mortgage holders have locked in low rates, it will make the transmission of that policy different this time and slower. You also see that, I think, when you look at services. A services economy has a different traction, I would guess, as it relates to that policy transmission. So it is a challenge for the Fed coming off the pandemic, coming off the supply chain issues that were complicating their analysis, to really understand that transmission. I think the risk, of course, and one they must be very mindful of, is that waiting too long carries important risk until they bring that inflation rate back down.
Esther, it was a true pleasure to get your perspective. Thank you so much, Esther George, former president and chief executive of the Federal Reserve Bank of Kansas City.